honest, if someone told you 5 years ago that companies would be buying billions of dollars in Bitcoin and putting it on their balance sheets, you'd have laughed. But here we are in 2026, and corporate Bitcoin treasuries are no longer a fringe experiment. They're becoming the new standard for forward-thinking CFOs. Let's walk through the 11 biggest shifts happening right now, and the numbers are staggering. Started with MicroStrategy. Back in August 2020, Michael Saylor made a decision that seemed insane at the time. Convert the company's cash reserves into Bitcoin. Fast forward to today, and that decision has generated tens of billions in shareholder value. MicroStrategy now holds over 400,000 Bitcoin, making it the largest corporate holder on the planet. And Saylor's thesis was simple. Cash is trash when central banks print money endlessly. Bitcoin is the hardest money ever created, period. The macro environment since 2020 has made this argument even stronger. We've seen inflation spike to 40-year highs. We've watched central banks print trillions. We've lived through bank failures and bailouts. Every time the system shows cracks, more companies wake up to the reality that holding dollars on a balance sheet is a slow bleed. 5% inflation doesn't sound like much until you realize it destroys half your purchasing power in just 14 years. It's the actual financial case. 3 things. 1. Bitcoin is a non-sovereign store of value. No government can print it away. 2. It's highly liquid. You can sell billions in Bitcoin faster than you can sell real estate, or even bonds. 3. It's asymmetric. The upside potential dwarfs the downside risk. Companies that held Bitcoin through the 2022 crash are sitting on massive, unrealized gains today. And with the new FASB fair value accounting rules that went into effect, companies can now mark those gains on their books. That was a game changer. It keeps growing. Tesla bought $1.5 billion and held through the volatility. Block, formerly Square, has been accumulating systematically. Marathon Digital, Galaxy Digital, Hut 8. The miners were obvious, but now we're seeing insurance companies and pension funds dip their toes in. Even nation-states are getting involved. El Salvador made Bitcoin legal tender. Bhutan has been quietly mining for years, and multiple U.S. states have introduced legislation to hold Bitcoin in their reserves. This isn't just corporate anymore. It's moving towards sovereign adoption. Mechanics are increasingly straightforward. You work with a qualified custodian. Think Coinbase Custody, Fidelity Digital Assets, or BitGo. You establish a treasury policy that defines what percentage of reserves go into Bitcoin. Most companies start small, 1 to 5% of cash reserves. Then there's the accounting. Under the new FASB rules, Bitcoin is treated as an intangible asset measured at fair value, meaning gains flow through net income. No more impairment-only treatment that made Bitcoin look like a liability. This was the regulatory unlock the industry needed. Real about the risks. Volatility is the obvious one. Bitcoin can drop 50% in a bear market, and your quarterly earnings will show it. Custody risk is real. If you lose the keys, you lose the Bitcoin, period. There's regulatory uncertainty. What if the SEC or Treasury changes the rules? And there's the optics risk. Some shareholders and boards still see Bitcoin as speculative internet money. These are legitimate concerns that any serious Treasury strategy has to address. This is where the real battle happens. In the boardroom, on one side, you've got CFOs who understand that holding cash is guaranteed to lose purchasing power over time. On the other, you've got risk committees who see Bitcoin's volatility and want nothing to do with it. The smartest companies are finding the middle ground, treating Bitcoin as a strategic reserve asset, not a trading position. 5% allocation, held for at least 4 years. That's the Saylor model, and the data says it works. Where this gets really interesting. As Bitcoin ETFs have opened the floodgates for institutional capital, companies now have even more ways to get exposure. They don't have to custody Bitcoin directly. They can hold ETF shares. But the truly conviction-driven companies want the real thing, not a paper IOU. And the network effects are growing. When your competitor holds Bitcoin on their balance sheet and you don't, you're taking a different kind of risk. The risk of being left behind. We're seeing the early stages of a corporate adoption cascade that could take Bitcoin to valuations most people can't yet imagine. billion of corporate treasury demand is $1 billion of Bitcoin removed from the market, with only 21 million Bitcoin ever to exist, and roughly 19.5 million already mined. The supply side is extraordinarily tight. When corporations start treating Bitcoin as a permanent treasury asset, they're not buying to trade. They're buying to hold for decades. That changes the supply-demand equation. Fundamentally, it's the biggest financial shift most people are completely asleep on. What matters? The corporate treasury trend isn't speculation. It's actuarial math. Fiat currencies are designed to lose value. Bitcoin is designed to hold it. The companies that figure this out first are going to outperform their competitors by orders of magnitude over the next decade. Whether you're running a business, managing a family office, or just trying to preserve your own savings, the lesson is the same. Holding hard money beats holding melting ice cubes every single time.